Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Cantaloupe Inc. quarterly report. Cantaloupe Inc., a digital payments and software services company, offers a wide range of technology solutions for the self-service commerce market. At its core, the company provides various payment processing systems, including micropayment processing, connected point-of-sale, POS systems, and enterprise cloud software. The company's product offerings include Jellivan Cashless and Pulse Kits, which are 4G LTE digital payment devices used for payment and consumer engagement applications. Additionally, Cantaloupe offers the Engage series of digital touchscreen devices that provide networking, security, and interactivity payment methods. The P-series card readers, including 66, P100, P100 Pro, and P30, also fall under this category. In terms of self-service solutions, Cantaloupe provides self-checkout kiosks, smart store concepts, and the Cantaloupe Go management platform, which comprises various modules such as Go Mini, Go Plus 300, and Smart Store Go Micro Kiosk. The company's Seed platform is a cloud-based asset management and optimization solution that includes remote price change software service. Furthermore, Cantaloupe offers additional services like Cantaloupe Go Portal, Seed API, customer/consumer services, professional services, network infrastructure, card processing, data warehouse services, digital ad management, campus card integrations, and loyalty programs through its consumer mobile app. These offerings demonstrate the company's comprehensive approach to providing technology solutions for the self-service commerce market. The past year has seen a significant increase in Cantaloupe Inc.'s CTLP stock price, with several key events contributing to this growth. The most substantial factor was the acquisition agreement announced on June 16, 2025, where 365 retail markets agreed to acquire Cantaloupe for $848 million. This news led to a surge in the stock, with shares rising by 15.11% on the day of the announcement. In addition to this major event, strong financial performance and analyst sentiment also played a role in driving up the stock price. In May 2025, Cantaloupe reported robust third-quarter fiscal year results, with revenue increasing 11.1% year-over-year and adjusted EBITDA growing by 36.6%. The company's net income was also significantly boosted by a one-time tax benefit. Analyst speculation of an acquisition in February 2025 further contributed to the positive momentum in the stock price. An analyst raised its price target to $13, suggesting that Cantaloupe would attract suitors, which likely fueled market sentiment and drove up the stock price. Overall, these events combined to cause a significant increase in Cantaloupe's stock price over the past year. The primary drivers of revenue growth or decline can be identified through a review of the key factors that have impacted an organization's financial performance. Revenue growth is primarily driven by several key areas, including subscription fees, transaction fees, equipment sales, and device rental programs. These areas have shown significant increases in recent periods, with subscription fees rising by 5.1% and transaction fees increasing by 8%. Additionally, the development of new technologies has also contributed to revenue growth, as well as the strengthening of customer relationships. On the other hand, revenue decline is primarily driven by a decrease in gross profit from transaction fees, which has declined by 13%. This decline is due to increased costs associated with transaction fees. Furthermore, total gross profit has also seen a decline of 3.9% in recent periods. The net income of the company experienced a significant decline in 2025 compared to 2024. The quarterly comparison showed a decrease from $4,974 million to minus $70 million, while the yearly comparison revealed a drop by $5,044 million. This substantial decline resulted in a loss of $989,000 for the year 2025. The profit margins also underwent a significant transformation. The operating margin decreased from 8.3% to minus 0.1%, and the net profit margin dropped from 6.7% to minus 0.1%. However, there were some positive changes in the gross profit margins. The gross profit margin for transaction fees decreased from 25.6% to 20.7%, while that of subscription fees declined from 78.8% to 75.9%. On the other hand, the gross profit margin for equipment sales increased from 9.1% to 10.7%. The reasons behind these changes are multifaceted. The increase in transaction fees costs due to higher processing volumes, was a major contributor to the decline in net income and profit margins. Additionally, the amortization of internal-use software assets and developed technology assets had a negative impact on the company's financials. Furthermore, the decrease in interest income due to lower outstanding balances also played a role. However, there were some positive developments, such as the increase in average ticket items sold, price, and processing volumes for transaction fees, which helped mitigate some of the losses. The company is generating positive operating cash flow, indicating a strong financial position. According to the financial statements, for the 3 months ended December 31, 2025, the net cash provided by operating activities was $23,119. This suggests that the company's core business operations are generating sufficient cash to meet its financial obligations. A closer look at the 6-month period ending December 31, 2025, also reveals a positive trend. The net cash provided by operating activities during this time was $10.1 million. While this figure is lower than the 3-month period, it still indicates that the company's operations are generating significant cash flow. Overall, these financial metrics suggest that the company has a solid foundation for its future growth and development. With positive operating cash flow, the company can invest in new projects, pay off debts, and reward shareholders, ultimately driving long-term success. The company's debt level has undergone significant changes over the past few years. Initially, on page 1, it was noted that the current debt level increased by $845 from $82,396 to $83,241. However, on page 20, a decrease in non-current debt by $1,019 million was reported, with the total outstanding debt as of December 31, 2025 being $37,705. This indicates a reduction in debt levels. Furthermore, on page 21, it was mentioned that the total outstanding debt as of December 31, 2025 is indeed $37,705, which is an increase from $0 in 2022. This suggests that the company has taken on significant debt over the past few years. In terms of interest expenses, there have been fluctuations. On page 2, it was reported that interest expense decreased by $233, or 11.7% from 2024. However, on page 42, an increase in interest expense of 11.7%, or $233,000 was noted. Additionally, on pages 44 and 45, interest expenses were mentioned to have decreased from $398,000 to $350,000, 3 months ended December 31, 2025, and from $845,000 to $700,000, 6 months ended December 31, 2025. Overall, the company's debt level has increased significantly over the past few years, while interest expenses have fluctuated. Management's outlook on the company's strategy is focused on both short-term and long-term goals. In the short term, the priority is to improve operational efficiencies and reduce outstanding accounts receivable through increased collection efforts. This will help increase cash flow from operating activities. In the long term, management aims to grow the business both domestically and internationally. Additionally, they plan to expand the Cantaloupe INC program by investing in innovative technologies and products, which will lead to an increase in rental devices enrolled in the program. Financially, the company plans to refinance existing debt and secure additional funding through a new credit facility. This will provide working capital needs and allow for general corporate purposes, including permitted acquisitions and investments. Furthermore, management is preparing for a potential merger with 365 Retail Markets, LLC, which will likely have significant implications for the company's future direction. The company's dividend payment history reveals a mixed picture over the past 2 years. In 2024, it did not pay any preferred dividends, indicating a conservative approach to shareholder returns. However, in 2025, it incurred a loss of $289 on its preferred dividend payments, suggesting that the company may be struggling financially. Notably, there is no indication that the company has repurchased shares or paid common share dividends during this period. This suggests that management may be prioritizing other areas of investment over shareholder returns through buybacks and dividend payments. There are concerns about inventory buildup or supply chain disruption. The data shows a significant increase in inventory levels over the past 6 months, with a total increase of $4,914 from June 30, 2025 to December 31, 2025. Furthermore, the company has reported an inventory increase of $4.3 million during this period, indicating a substantial buildup. This trend raises concerns about potential supply chain disruptions and the need for efficient inventory management. The company's focus on utilizing existing inventory to support equipment sales over the next year suggests that they are aware of these issues and are taking steps to mitigate them. However, conflicting information on page 6, which shows a decrease in inventory levels from 2024 to 2025, adds complexity to this situation. The increase in accounts payable and accrued expenses also warrants attention, as it may indicate difficulties in managing cash flow or paying suppliers on time. Overall, the data suggests that the company is facing challenges related to inventory buildup and supply chain disruption, which require careful management to prevent potential disruptions. That concludes the financial summary for Cantaloupe Inc. Feel free to comment below, and I will be happy to answer them when possible.